that I want to cover today. I want to get into some headlines that are relevant from a digital asset and Web3 tax and accounting perspective. We're really at no loss of headlines because Bitcoin and crypto and just the overall regulatory environment around Web3 is a huge topic right now. And as you'll see from some of these headlines, that's going to continue in the future here. So I want to cover some of those items. There's a couple tax questions that I see floating around online right now across Reddit and Twitter. I want to hit on those as well. And then a couple things that I'm seeing at my practice that I want to cover and go over here as well. Try to be proactive for you guys to give you some things to look out for. So that's what I want to cover today. Let's get started here right away. I'm going to start by sharing my screen, so bear with me here. Let's see. So there we go. I'm just getting myself situated here on my desktop. So this Web3 tax and accounting masterclass actually, as you can see, this was shot yesterday. This was an audio event that we did on LinkedIn, me and Zach Darris. We had about 540 attendees, and it was a great event. We covered a lot of tax topics in a short amount of time. We really packed a ton of information in on this masterclass. And right now, it's something Zach's putting together in terms of releasing the audio for people that want to rewatch it. Keep an eye on my profile, keep an eye on his profile. We'll be reposting this audio event. And again, it's packed with information. So if you weren't able to join live and listen in, then watch the restream of it, and we cover a lot of information, a lot of great Q&As from the audience as well. So overall, it was a great event, and I think you'll benefit a lot from watching that. Then coming up, me and Camuso CPA have partnered with the crypto CFOs, and we're doing an event on their platform. So in order to watch this event, you want to go to cryptocfos.com and you want to sign up for their platform, the Crypto CFOs, which I'm a part of. I think it's a fantastic platform. If you're in the digital asset and Web3 tax and accounting space, you definitely should be joining this. There's a wealth of information on there that's, not going to be on Twitter, not going to be on LinkedIn. It's going to be in this private group. And this free CPE course that we put together is a great example of this. So this course is going to be going over demystifying NFT sales taxes, which this is currently an overlooked topic in our industry that moving forward is going to start gaining a lot of attention, and it's going to cause a lot of compliance issues, particularly for marketplaces and NFT sellers and just Web3 businesses in general. So that's what I'm going to be going over here on August 2nd. It's going to be a 1-hour CPE event, and we're going to be going over everything that you need to know about NFT sales taxes. So if you're a tax professional, if you're a CPA, if you're an accountant, if you're a CFO, and you're working with individuals that are selling NFTs, involved in Web3, or just involved in digital assets overall, this topic is crucial, and it's crucial for you to understand this so you can start advising your clients on this, making them aware of this now, and really fill that role of being a proactive advisor that's taking steps to look out for your client and not just sort of react to whatever tax issue they're having. This allows us to sort of show them what to expect, how to get into compliance, and really do what I think our job is in Web3 as CPAs, is giving that proactive advice and telling clients things to look out for that they may not have been aware of if they weren't working with us. So I'm really looking forward to this event. I think it's going to be great. We put a lot of work in on it, and I believe my knowledge when it comes to NFT sales taxes is unrivaled because I've just been on top of this topic and the developments around it since its inception. So let's get into the headlines here. So you're going to see a theme in these headlines here today, and that theme is one of enforcement and just overall attention from tax authorities. And you can start to see sort of what the trend is going to be going forward here to a certain degree. So, sorry about that. So, the IRS is coming for cryptocurrency. So, this is from the Pittsburgh Post Gazette. Um, so, basically, this article is just highlighting the a fact that I've been highlighting here, if you've been sort of watching these past lives, is crypto is a huge focus for the IRS moving forward. You know, a lot of people like to think the IRS, doesn't understand crypto, doesn't care about it. That's never really been the case. They've, always been sort of positioning themselves for enforcement actions over the years, through various data collection efforts and tax notices they sent out. They sort of have been taking preliminary steps towards enforcement. Um, but I think that's going to start to increase going forward. And that's basically what this article is outlining here. So, they say it really started out a few years ago, 5 years ago. There was only a handful of people involved in crypto. And I could say, I've been in this industry since 2016 professionally. But before that, personally, as just an investor and an enthusiast, and the industry has just it's completely night and day from 5 years ago. The amount of growth and just some of the changes in the types of market participants that I've seen, the growth is really just amazing to see. Living in this industry and through these market cycles, it's like you take, 5 years and it's like 15 years because the market cycles are so condensed, which is a great learning opportunity. So, yeah, they're saying people were dabbling in it 5 years ago, but the number of clients in this has increased. So then they go on to say that more people are becoming interested in crypto, but due to the decentralized pseudonymous nature of it, it's harder to track for tax purposes and causing problems for tax authorities. But then it goes on to say digital currencies is now in the crosshairs, and it goes on to say how property is taxed. They go on to highlight, this article is very well written. They go on to highlight Operation Hidden Treasure in 2021, where that was designed to root out taxpayers, and they go on to discuss the Inflation Reduction Act, which the Inflation Reduction Act, as they're outlining here, allocates $80 billion to the IRS, and a large portion of that is designated for enforcement activities. In that report, or in that Inflation Reduction Act, when it came out, it's been a while since it came out. I covered that when it came out, but there is a very large focus on cryptocurrencies within that report, just like they're saying here. And that's just the beginning, as they say. So the IRS Strategic Operating Plan for 2023 through 2031 lays out the agency's intention to ramp up enforcement action related to digital assets. So I like I said, I've been saying this a lot. We've been seeing a lot of headlines regarding that. We've even seen headlines from some of the IRS's criminal enforcement department maybe 6 months ago saying that you should expect to see more enforcement here in the future. So let me see if there's anything else I want to hit on this. I think that's the big things on this one. Yeah, I think that's the big points on this one. So then they go on also to talk about the IRS doing the John Doe audit. So we actually covered this on the live I did yesterday with Zach Darris in that Web3 tax and accounting masterclass. The John Doe audits are a big tool for the IRS to sort of collect the initial information from exchanges, and then they can use that information to identify people that are not reporting, also to trace those transactions possibly to non-custodial wallets and other places where you're on ramping or off ramping that you may have activity that they could link to your identity. So that's the big things from this article. So overall, just more headlines that the IRS is coming for non-compliant crypto taxpayers. Then going into this next article, you'll see IRS investigating crypto traders using Puerto Rican tax breaks. So this article says the noose is tightening for wealthy Americans suspected of exploiting Puerto Rico's relaxed tax regime. So moving to Puerto Rico is a very popular strategy. There's a lot of crypto people there. I've seen a lot of my clients move there over the years. And the reason why is basically if you move to Puerto Rico and you meet certain requirements, and they are stringent requirements, you can reduce or even eliminate some of your taxes, your capital gains taxes or your income taxes. I'm not going to get into all the details of Act 80 and 84, but basically you're allowed to exclude a large or a full portion of your capital gains and income depending on your facts and circumstances. Now, one of the big requirements around this, and there's many requirements around it, but the big one is you have to live in Puerto Rico for a certain amount of time each year. So I believe it's 183 days that you need to stay in Puerto Rico each year. So with this article, you have to stay there for that time period in order to receive those tax benefits. If you don't, then you don't receive the tax benefits. And there's many other requirements, but that's really the big one they're harping on here, I believe. So you'll see this article says they're investigating wealthy crypto traders and fund managers suspected of illegally benefiting from Puerto Rico's tax breaks. So they're targeting hedge fund managers, crypto traders, and other wealthy people on the island who may have lied about the nature of their residency, which is what I was alluding to there. So, the IRS is claiming that they're claiming residency on that 183 days and possibly staying for less time than that. And other key elements of their income to take unfair advantage of the tax breaks. So there's at least 2 criminal investigations expected to result in charges in the near future. Prosecutors are looking at conspiracy and wire fraud charges as well. So this is just another focus of IRS enforcement. This is somewhat targeted at the Puerto Rico tax breaks, but one of the huge benefit factors of that is the crypto industry. There also is just a lot of just investment management companies, hedge fund companies, and things like that over there. But a huge group of people that are taking advantage of these tax breaks in Puerto Rico are crypto traders, cryptocurrency investors. So you'll see more than 5,000 individuals have relocated to the country to, through this tax program. It goes on to highlight some of the benefits of it. It grants individuals 100% exemption on dividends, 60% on municipal, 0% on federal taxes. And then you also have 3,600 businesses that are benefiting from this, which they also receive tax benefits that they outline here. So there's just huge tax benefits associated with this. You'll see one of the notable residents here, Peter Schiff, which obviously we all know who Peter Schiff is, and also crypto investor Michael Turpin. So Peter Schiff already got his bank shut down based off of this. I remember when he posted about this a couple weeks ago, he wasn't very happy about it. It's unfortunate to see that they shut his banks down before, like he's saying here, no evidence of crimes. They regularly shut his banks down. They didn't really give him, he's claiming they didn't really give him, any notice or any sort of criminal process, but that appears to be the process here, unfortunately for him. So this is another area that they're going to be targeting here. So this just goes along this theme of IRS tax enforcement that's going to be ramping up. Now, this article is not IRS related. This is more worldwide taxation. And in my practice, I do focus on working within the United States. That actually was a question I was getting a lot yesterday. I do primarily work with United States investors and businesses. Now, do I have clients that are outside of the United States? In some isolated cases, I do. Usually those are going to be clients that maybe moved out to a different tax jurisdiction like Puerto Rico, like Portugal, like Switzerland. And, maybe we handle parts of their accounting and they use local tax experts for the parts of their tax and accounting needs that we can't fulfill. But, 98%, 99% of our clients are located in the US. With that being said, over the years, I always try to look at what's going on from a regulatory standpoint and just from like even a news standpoint related to tax enforcement and just tax policies across different countries, because oftentimes, smaller countries can implement policies and then we can see similar things happen in larger countries like our country. So that being said, I do try to look at things not only in the US, worldwide. And this one's interesting. So crypto boss jailed for failure to file tax documents. So this is actually out of Turkey. So I'm probably not going to be able to pronounce these guys' names correctly. Um, but they've been sentenced to 7 months and 15 days for failing to provide tax documents. So these guys were in a lot of legal trouble, but ultimately failing to file tax documents has landed them in jail. So a Turkish court has sent the founder of Theodets, Farouk Ozer, to 7 months and 15 days for failure to submit tax-related documents. So, they requested these tax documents for audit purposes likely, and he failed to produce them, and he basically was claiming that he had no access after the exchange filed for bankruptcy, which, if you remember, we covered an exchange that filed for bankruptcy and that you need to save your tax documentation from it. I covered that maybe 2 or 3 weeks ago on one of these live events. So, originally his sentence was 5 years and they revised it down to 7 months after reviewing his behavior. So basically, this guy was already on the hook over there for facing accusations of allegedly defrauding customers of his crypto startup, and he's on Interpol's red list. So, there's a lot to this story. It's not just a tax enforcement case, but this is sort of like another FTX type case here. Former crypto boss suspended the exchange's operations following a partnership offer, lost customers' funds. But, basically right now he is sitting in jail over not providing those tax documents. So you can see that tax enforcement is a big tool that is sometimes even used to catch bad actors that are doing things arguably even worse than tax evasion in terms of just defrauding people. So, it's interesting when people think crypto is this anonymous thing that is difficult from a tax enforcement perspective, but then you can see examples here on where, the tax enforcement was sort of a low hanging fruit here for prosecutors in this case, which I think is interesting. So that's really what I wanted to cover here. It's just a lot on the enforcement front, both here domestically and then, as you can see on this case as well. So another interesting, sorry, we got this ad popping up here. Let me close out of this. So, and I'm not looking to get political on these, but the elections are coming up, and Bitcoin and crypto in general is going to be a huge topic. So we're going to be covering these things just from that perspective of looking at, the regulatory trends and just the overall tax and accounting trends, and just with the different positions and talking points that we're going to see regarding this. I'm not going to get into saying, vote for this person or vote for this person. That's not really what I'm looking to do here. I have clients that are on all sides of the aisle, so I'm not really looking to input my perspective into this at all, other than my tax and accounting and just regulatory perspective. So last week, I was covering the Biden administration, or even over the past couple of weeks, because the Biden administration has really been pounding the drum against cryptocurrency, against Bitcoin. Um, Biden pushing the Deem tax, basically the excise tax on mining, pushing to apply wash sales to cryptocurrencies and other items like that that you've probably seen me cover in the past. So, they're taking more of an adversarial stance and sort of speaking against Bitcoin and cryptocurrency, at least to a degree, looking to regulate it very hard, tax it very hard. Now, just a couple of days ago, RFK Jr. announces a plan to back the dollar with Bitcoin and end Bitcoin taxes, which I think is interesting. How much of this is rhetoric versus how much of this will actually be followed through on is up for us to question at least. But I think it's interesting, and I just love our industry is on this national scale going into this election. I really do like that. I think it's very interesting. We've come a long way over the past 5 to 10 years here. So um, he was quoted saying, "My plan would be to start very, very small, perhaps 1% of issued T bills would be backed by hard currency, gold, silver, platinum, or Bitcoin," Kennedy said, describing his vision for returning to a hard currency standard in the US. Obviously, I wouldn't have gotten involved in Bitcoin so early if I didn't dislike the, money printing and how the current fiat system that we're under now. I do think it's would be pretty difficult to go back and do something like this now, considering how much we are printing and that the economy is based off of that. So I love the idea. I'd like to see it. Is that possible, or is Bitcoin and its fixed supply more antithetical to our current fiat system and need to, be printing dollars? I think that's up to question. But overall, I think having sound money is the foundation for a good society. So, I like seeing that. And then let's see here, because he also was yep. In addition, Kennedy announced his administration will exempt the conversion of Bitcoin to the US dollar from capital gains taxes, which I would love to see that, of course. Me and my clients will enjoy some tax breaks in that regard. Now, I think the wording here was interesting. Will exempt the conversion of Bitcoin to the US dollar from capital gains taxes. So probably, other cryptos at least based off of that quote would be taxed. And probably if you're converting Bitcoin into other assets, they may still be taxed. But going from the Bitcoin to the US dollar, he's saying he would want to exempt that from taxes, which again would be, very interesting. Obviously, I wouldn't be complaining about that, and I doubt you would either. At least if you're, holding Bitcoin yourself. So I think this is interesting. I think it flies as a stark contrast to the Biden administration and how they're sort of taking a stance of, regulating Bitcoin hard, taxing it very hard, and making it more prohibitive for people from a tax perspective. So I think is very interesting. And on the other side of things, we've seen Donald Trump come out with headlines regarding Bitcoin in the past, and isn't too favorable to it. Views it as competing with the dollar, which I probably wouldn't necessarily disagree with. So it's just interesting seeing the different positions and the different tax proposals that are coming out of these different candidates. And it's something that we'll want to watch closely, because what comes after elections, and that is tax changes. So I think this was an interesting topic. So a couple other things I wanted to get into here were some tax questions that I saw floating around out here. Um, So this person is saying balance is not correct. Currently saying they have a balance of 0.54 quant on their Newton wallet. This is incorrect. Coinly shows that I sent out quant to my other wallet, but there appears to be no way to alter the balance. So he's trying to figure out how to fix this issue. He correctly has reviewed his ending balances, which I always stress doing, and he's comparing the ending balances that he calculated to his actual ending balances for the tax period in question here. And now he's saying that his calculated balance in quant is overstated. What that indicates to me is that somewhere in the calculation, he's either treated a transfer as income, he's double counted a purchase, he's overlooked a sale, he's done something incorrect in this calculation that's overstating this ending balance. Now, when he's asking, there appears no way to go back and alter the balance. Well, no, you can't just go to your calculated ending balances, click in there, and wipe it out to zero, because there'd be no integrity to your actual calculation. So what he really needs to do is go back and reconcile quant, and really try to find where that issue is in the accounting. Is it an overlooked sale? Is there a transfer that it should be treated as a sale? Are you double counting your purchases? These types of things. So you're going to have to go through, you're going to have to reconcile that, and you're going to have to figure out where that error is, make that appropriate adjustment, and then that ending balance will be correct. So this is where the rubber meets the road with these calculations, is during this due diligence process, particularly comparing actual to calculated ending holdings. This is where you'll see if there's issues in the calculation that need to be addressed. So I suggest everyone do this due diligence check, even if you're working with a CPA firm. For some reason, I'm seeing a ton of new potential clients come across my desk that have worked with other CPA firms, and there's just no due diligence done at all. And I look at it and it's just egregious errors. Unbelievable, honestly. Just assets that clearly should have market values associated with it. They'll have, I saw someone the other day, their accounting firm at the end of the year calculated they had about $32,000 in USDC, and the market value of it was $0. I mean, that's just blatant not doing your due diligence. It just shows that these ending balances are just not even being checked. And that's one example that comes to mind. I can start naming off a bunch of different assets that I see that on, but ultimately it's the same thing. There's just inaccuracies either in the coin balances or in the pricing and fair market values that are applied to these. The issue with having these ending balance variances is it indicates that there's likely issues in the current year calculation, but also because these are ending balances that carry into next year, these can start impacting you on future tax years as well. So, it just creates a multi-year headache that eventually when you try to unravel it, it can lead to you having to go back into multiple years of tax returns and amend them. So it's something that you need to be cognizant of. You need to be very careful with during your due diligence process and pay very special attention to this. So that's really what I wanted to hit on regarding that. So in here, I thought this was another interesting question. So does anyone have a completely different result for their totals in Coinbase versus CoinTracker? The answer here is that yes, you will. Firstly, on Coinbase, they're only going to be able to report to you what happened on their exchange. So if you've transferred in assets from non-custodial wallets or other exchanges into this exchange, it's unlikely that your cost basis information is going to be reported correctly by them. Therefore, your gains will likely be overstated. And, the way that we have to address that is by actually doing the proper accounting and then reconciling that to any 1099s or tax reporting that you may receive. In that same regard, regardless of the tax software, it doesn't matter which one it is, Coin Tracker, Coinly, or the list goes on. I can sit here and probably rattle off 30 or 40 different of these softwares. None of them are going to be plug and play where you just enter in your wallets, enter in your exchanges, and it gives you a good tax calculation. I've yet to see that happen. So don't bet on it. There's always going to be a reconciliation process that you need to do. There's going to be transactions that need to be categorized appropriately that are not coming across correctly in the APIs, particularly if you're purchasing NFTs or if you're working on more complex DeFi protocols. These are the types of transactions you're going to have to get into some detail on, track and trace through the Block Explorer, make the appropriate updates and tax adjustments within your accounting software. So, the reason why his Coinbase maybe isn't accurate is because they don't have full information. But then even if you go and you plug everything into CoinTracker, that doesn't necessarily mean that's going to be fully accurate as well. I bet if he went to CoinTracker and, 5 other softwares and plugged the same stuff into all the softwares, he may be getting different results across those. So ultimately, you don't want to rely on an exchange to tell you what taxes you owe, because they're not going to have all the information. You don't want to rely on just plugging stuff into one of these softwares without doing a proper categorization, reconciliation, and due diligence, because neither is really going to get you the correct result. And inaccuracies can hurt you for the tax year that you're filing for. And again, it can carry into future tax years, which is just a complete nightmare. So this is what we want to avoid. How do we avoid it? You need to follow a good accounting process, like I've been trying to outline. Do your proper due diligence, and preferably you should be working with an experienced crypto CPA. Now, the last thing I want to mention is one thing I'm seeing is a lot of lack of due diligence across many firms. And the way that I'm learning this is because, number one, I have new potential clients that are doing initial consultations with me at Camuso CPA. I'm trying to assess where they're at. A lot of them, have prior accounting work done that I'm reviewing. And many times I'm just completely shocked by what's being done. Completely shocked. And, there's just clients just getting, paying good money, good fees, and getting just complete garbage work with no due diligence. And again, I'm just shocked when I see it. A lot of times it does look like some firms will basically just take people's information, plug it into CoinTracker or into another software, give them the reporting outputs, and basically call it a day from there. So if you are in the position where you're looking for a crypto CPA, you need to vet them properly. You need to understand, what is their approach to their accounting process? What is their due diligence process? There's a list of questions that you should be asking them that I think I maybe touched on during the live last week. So I'm not going to drill down too deep on this, but you need to be doing your due diligence because, the accuracy of your accounting and the repercussions of inaccuracies ultimately are going to fall on you, the taxpayer. So you need to make sure that they're accurate. You need to do your due diligence on your accountant and on your portfolio. So there were some other topics I wanted to get in here today, but I know we've been going pretty long here today. So I'm gonna shelf some of the topics that I have left, and we'll save those for next week. I hope that you gained some value out of this today, and I really appreciate you taking the time to listen to this today, and I hope you gain some value from it. If you're looking for more information, visit my website. We release a newsletter called Digital Asset Digest directly to your inbox every Tuesday with the latest tax tips, the latest regulatory news, and the latest Web3 accounting updates. So sign up for that on my website. Go to camusocpa.com, go under the resources tab, go to the newsletter sign up for that, and we'll drop that directly in your inbox. And it'll be valuable information that will keep you ahead of the game when it comes to taxes and accounting. Otherwise, if you did gain value from this today, click the share button, share this across LinkedIn. Use this as an opportunity to deliver this information to your network, add some value to them, show them what to look out for from a tax and accounting perspective. Let me sort of give them some tips here, and you can gain some credit for it because you're pushing the information to them. So again, I really appreciate you guys listening today. Until next week, I'm Patrick Camuso signing off.